So I recently read a study that suggested younger siblings are generally more athletic than their older brothers and sisters. And when you consider examples like Michael Jordan, who's arguably the greatest basketball player of all time, had an older brother named Larry Jordan, or even Serena Williams being the younger sister to Venus and surpassing her stellar tennis career, you get to see a ton of support around the argument. And so the study pointed out that the biggest contributing factor, or just why this is even a thing, is because younger siblings, being smaller and trying to keep up with the older ones, have to work harder, but they also get to learn how to do things from their big brothers and sisters. And I believe that one of the biggest advantages that crypto has is being the younger sibling in the financial system family, because it positions crypto to learn from its predecessors. Now, many may point to the fact that crypto was actually born because we learned what not to do in a financial system, right? Of course. And although that is true, there's still some nuggets of wisdom that can be gleaned from our traditional systems that, could be invaluable if not ignored. One such example is the Buttonwood Agreement. Now, whether you've heard of this document or not, go ahead and hit that like button and subscribe to the channel, because today I'm going to tell you a little bit about the Buttonwood Agreement, but more importantly, I'm going to explain what crypto can actually learn from this agreement, and if we can apply it, crypto could be even greater than its older financial system siblings. So let's jump in. So here in the United States, most people associate the stock market and investing with Wall Street. I mean, Hollywood has made numerous movies about that small little financial district in New York City and the cutthroat brokers who keep the machine churning through greed and gain. But investing actually even predates Wall Street and even New York City. In fact, historians report that investing is probably as old as man is, because there are records of ancient merchants investing in goods to sell at higher price points in the future. But investing into stocks in the way we understand it today can actually be tracked back to the early 1600s, when the Dutch East India Company became the first publicly traded company in Amsterdam. Now, the Dutch East India Company was wildly successful, and investors did very well on their investment. And so investing into companies became viewed as a lucrative opportunity. And you know what? This captured the attention of the public. And so when the Dutch and other European settlers decided to migrate to the Americas, they brought with them some things. I mean, they brought this new concept of freedom, they brought cookies, and of course, this guy right here, Santa Claus. But they also brought the mechanics of investing, and just like in Amsterdam, it caught on quickly. Now, a problem they eventually ran into is something the crypto market has been hit with in the past, but is still dealing with today. You see, by the late 1700s, investing into stocks was a known practice, but it was sort of like unorganized. I mean, this was years before, Billy the Kid or Doc Holliday, but because of their approach, participating in investments was, sort of like the Wild Wild West. I'll be your Huckleberry. And so, although there were plenty of credible investment opportunities, there were also numerous cases of investors just getting taken advantage of. People were regularly misled about an investment, either through, indirect confusion about the opportunity, or just downright directly defrauding the buyer. Also, there were established brokers at that time, but you could basically buy stocks anywhere, and so there was no guidance offered by the seller, and there was no assurance offered around the authenticity of the investment. And again, I see major parallels of this early investment market to the existing crypto market we have today. The access to decentralized exchanges allow people to basically buy into any type of crypto investment at any time without any sort of guidance. And again, no fault to the actual exchange itself. I'm all for the decentralized form of the market, but although investors can get their hand on plenty of credible projects, they're still susceptible to falling prey to what we call rug pulls or scams. And every time the news reports on criminal acts in the crypto industry, it crushes the positive perception the market has tried to build over time. And that negative sentiment we have seen attack crypto is similar to what the early traditional investment market experienced before the Buttonwood Agreement. There were years of scandalous acts that plagued the early investment market, but it wasn't until an event known as the financial panic of 1792 that things began to change. History tells us that loose lending guidelines and the first recorded act of insider trading were to blame for a deep economic downturn that brewed fear, uncertainty, and doubt around the financial system at that time. It was so bad that even parts of the government considered banning the brokerage industry altogether because so many people were horribly affected. In response, a group of 24 merchants got together and formed an alliance to create the first organized group of stock traders in New York City. This group, who would regularly meet under a buttonwood tree to perform stock trades, wrote up and each signed the Buttonwood Agreement, committing to the provisions of the agreement. Now, I'd love to tell you that this document was some long legal document that went into the deepest crevices of financial litany, but the truth is, the document was short. It was real short. It was basically 2 sentences long. And so the signees agreed to, number 1, only dealing with each other. And number 2, they would charge commissions at a set rate. Now, this agreement was pivotal for the early securities market because it spoke to the current issues of the day. Before the agreement, stockbrokers would charge a variety of commissions, which caused confusion on the actual value of the stock. And as I mentioned, pretty much anyone can sell securities, so there were plenty of questionable transactions at that time. But perhaps the biggest gain the agreement offered was a step in the direction of trust. People wanted to participate in the market, but hearing stories and possibly experiencing shady acts firsthand definitely scared people away. And so the Buttonwood Group, promising to not rip people off on commissions and to only deal with each other, conveyed a level of trust to the public because members were vetted and any securities offers were also vetted as well. This group of 24 brokers understood that an organized and united front would be necessary for the overall survival of the securities market. And guess what? They were right. This same group went on to become the New York Stock Exchange. And think about this. Over 200 years later, they are the biggest stock exchange in the world by market cap, with tens of trillions of dollars listed under them. So what am I saying here? Am I saying that the crypto market needs to create a Buttonwood Agreement? Well, not necessarily, but what I am saying is that the crypto industry definitely needs to have better established trust parameters. We need some creative option for protecting the investment public from greedy criminals. In late 2021, a crypto project named Squid Games launched. And you know what? From the moment it was introduced, it was totally obvious that the founders chose the name to feed off the popularity of the already established Netflix TV show. And you know what? That choice actually helped their marketing. They also chose to promote the project as a play-to-earn game where users can earn these squid tokens for participating in the game. The premise was attractive. It was so attractive that the project grew from 1 penny per squid token to topping out at around $2,800 per token. There were early investors who literally saw millions of dollars overnight, and like a bad magic trick, in one day, that project disappeared. The money vanished and the founders became unreachable. It was reported that more than 43,000 investors had bought into the project and even to this point cannot get any of their money back. Let me ask you this, how does something like this happen? How can 43,000 people get rug pulled intentionally and some type of reformation is not offered? And I know that some may be thinking, this is just the nature of the beast. When you buy into projects that are below the top 100 cryptos, you're entering into dangerous territory. And I get it. And in fact, I'll agree to an extent. But when you begin to unpack the recent Terra Luna controversy, you get to see a different picture. Now, let me say this. From what we can tell, it does not seem that the Luna's project started with the intention of defrauding investors. I really do believe they were trying to compete in the big blockchain race. With that said, there were definitely some shenanigans that happened before and after the collapse. And so essentially the original Terra Luna was a blockchain like Bitcoin or like Ethereum, and they had two coins, their Luna coin and their stable coin UST, which followed the price of the US dollar. Now these two tokens were pegged together or, tied together. They needed each other to work. So when an attack on the UST happened, and it was quite obvious that it was an attack and not just coincidence, it basically created a chain of events that included the collapse of both the Luna coin and the UST coin. And the Luna Foundation was forced to sell off in a fire sale the Bitcoin they had been accumulating for protection. I mean, through the whole ordeal, investors lost billions, and even companies like Three Arrows Capital suffered significant losses to the tune of $200 million through the ordeal. And you know what? It's still uncertain if they will be able to recover. Events like the Luna collapse and the Squid Game scandal creates uncertainty with the general public, and it bars new investors from being confident participating in this space. At the time of this video, buyer sentiment is low, real low. And there are parts of our government that are calling for more regulation. And to me, this sounds just like the story of the early investment market. Where we are now is where they were before the Buttonwood Agreement. Now let me say this, all markets have their ups and downs, of course, and I'm not opposed to, some form of regulation if it's thoughtful and sensitive to the crypto ethos. But what is most important right now, and what participants in crypto should be focused on, is inventing better trust protocols. I mean, we have the brightest minds in the world building a brand new financial system. And for it to survive in the way we want it to look like, in that, that decentralized format, #WagMe, actions need to be taken to instill trust. Maybe it's as simple as creating a document 2 sentences long that establishes trust by weeding out the bad actors. Or, who knows, maybe the answer is more complex than that. Either way, investors need to feel a level of safety participating in the market, and the people who live, breathe, and understand crypto should be the ones to bring answers to the table and address any concerns that emerge over time. And just like the Buttonwood Agreement will be remembered as marking a needed shift in the traditional investment market, I mean, who knows? Maybe 200 years from now, people will admire the steps we take today and look at our actions as the moment when things changed in crypto and we chose a better way. But let me know your thoughts. I mean, what do you think about the Buttonwood Agreement and how it can apply to crypto? Please let me know in the comments. Also, what are some ways we can create more trust in the crypto market? Please share some ideas in the comments. And lastly, I want to thank you for your time. Your time is so valuable to me, so I do hope you found value, and until next time.